Welcome to the lesson on output, price, and profit, the importance of marginal analysis. So we mentioned a lot of our work in the next week or so, the next few lessons are discussing firm behavior. So before we discuss the specific markets the firm engages in, we've already talked a little bit about the costs, we just want to take a deeper look at how do firms make decisions in general. I think giving this type of background will help us considerably when we get to discussing the details between a perfectly competitive market versus a monopoly versus some of the other types of markets. Marginal analysis. We've seen the word marginal now many times. Once again, when we talk about something marginal, we're talking about incremental decisions. So when we say marginal analysis, what is a small change that happens when you add a small amount of an input? If you're a firm, perhaps you're looking at the extra cost when you decide to sell one more unit and the extra revenue you'll gain when you decide to sell one more unit. What we will be talking about is the optimal decision from the firms, and we are going to soon discuss the assumption that firms maximize profits. Consumers, when you're looking at the marginal analysis for consumers, it's usually to maximize utility within the confine of a budget constraint. As we get started on this, it's worth noting that the firm has the choice for what quantity they would want to choose if they have any market power, or what price they want to charge, but those two decisions go together. They do not have the ability to set the price they want to charge and then decide how much they'd like to sell, right? I mean, there's some demand for the products of the firm. So if the firm decides it would like to sell a certain number of products, there's a price they will obtain from that. If they would like to lower the price, they might be able to sell more, but a firm just arbitrarily isn't able to sell more without some change on the price. Actually, if they can, either they're in a competitive market, which we'll talk about later, or they're not pricing very efficiently. So when we look at the demand curve, each point represents a price-quantity pair. So here, looking at bushels per week versus the price, at $6, the quantity that's paired with $6 is 400. If this firm wanted to increase the bushels per week to 500, they can, but they aren't going to be able to keep selling it for $6, right? We know from the law of demand, you increase the quantity, price would drop. So increasing to 500, you have to drop the price to 5. The firm is constrained in a way by this, that the price and quantity, it's not two different decisions, it's one decision, and it's going to be based on whatever the demand curve is for the firm's product. We'll be talking a lot, in order of the profit of the firm. The profit's going to be the total revenue minus the total cost. When we talk about a firm's costs, we don't just mean only what are known as the explicit costs. We don't just mean the explicit costs, so the costs that would be easily seen on a tax statement. And the explicit costs that are explicitly noted down. Hiring individuals, right? If you pay somebody a salary, that's an explicit cost. If you're back to Domino's, they have to hire workers. They would have to buy cheese and dough and sauce. All of those would be explicit costs. They'd have to pay for the building and also electricity. All of those are explicit costs. At the end of the year when they're doing their tax statements, all of these are written down costs. There are other costs though. There are other costs that are involved. If you run a business, and that because you run a business you can't spend your time in some other way, that's a cost, right? If you don't decide to take a traditional 40-hour per week job when you graduate and you decide to become an entrepreneur, you are giving up a full salary. That should be factored in when you're deciding, is this wise for me to stay with my business? The firm's own money matters, and it matters in a different way. When If a firm makes an investment into a company, or if a person decides, I'm going to start my own business and I'm going to put some of my own money into this company, when doing that, what we will be counting is not the money itself that goes into the business. We will be counting the interest lost off of that money. So the money is earning, you spend $100,000 in a business, that $100,000 helps the business earn money. Without the business, that $100,000 likely would have earned some money in a savings account or in the stock market. That lost interest is a cost. It won't be written down at the end of the year, the tax statements, but it does matter. These last three are certainly important: depreciation, risk-taking, and patents or other special advantages. It's not something we're going to be studying too closely in this class, but certainly if you are Coca-Cola, you know the fact that you have the secret recipe for Coca-Cola, that is a very special advantage. If you were Coke and you wanted to sell that recipe, you could make presumably billions of dollars. The profitability, you should take that into effect as a cost, because you have an asset that's worth billions of dollars, that secret recipe. For Coke makes so much money, certainly they wouldn't want to sell it. But if their profitability decreased, it might become a question. Same with KFC and their Colonel's 11 secret herbs and spices recipe, right? That has value to the firm. That's a special advantage they have, and that a monetary cost should be applied to that to see, is it smart to stay in business or not. So when we look at profits, we're going to be looking at the total opportunity cost of running a business. Now, the total costs will be both the explicit and the explicit. So total revenue, I guess first we'll define total revenue, the total amount of money the firm brings in without deducting the costs. This will be, in most cases, simply price times quantity for the products that the firm sells. There's two different types of profits that we'll look at, and in some of the problems you'll deal with, you'll see the differences between this: accounting profits and economic profits. So accounting profits are profits that don't have the implicit costs. And the term accounting profits comes up because these are often the profits an accountant would consider when doing the end of year taxes or doing the books at the end of the year. So it's the total revenue minus the explicitly noted costs, like the labor costs, the costs if you're Domino's, once again, for the materials, the sauce, the dough, the cheese, all of that. In terms of whether or not it's smart to stay in business, accounting profits aren't the correct measure. You should be looking at the economic profits. That would take the total revenue minus the explicit costs. So it would take the accounting profits, but then you would also look at the total implicit costs to determine whether or not it's smart to stay in business. So for instance, if you decide to open a business in Selinsgrove and you earn $50,000 in a year, that doesn't tell us whether it's smart for you to stay in business or not. You have to look at the implicit costs. How much money is invested that could be used for other things if you close the business down? If you stopped being part of the business, how much money could you make elsewhere? Right? Those questions will help determine whether it's wise to stay in business or not. At $50,000, some people it'd be smart to stay in business. Some people should leave and get another job because they could make more than $50,000 a year at a job that pays them directly. So the accounting profits are useful for accountants, hence the name. The economic profits, though, when we're trying to figure out if is it wise for somebody to stay in business or not, economic profits are what we'll want to look at. So here's a problem. We have two of these that we're going to go through, and for both of them, we'll follow the same format. What I'd like you to do before the video goes ahead and shows the answers, take a moment to pause to try to figure this out. So a business person decides to start her own enterprise. She quits her job. She was making $50,000 a year. She quit that, so she's not making that anymore. She made an initial investment of $100,000. The first year, the business earns $55,000 in revenue and has $10,000 in explicit costs. We're assuming an interest rate of 8% here. What I'd like you to do is pause it in about 10 seconds to determine what are the economic and accounting profits for this business. So go ahead and pause it now. Okay, I hope you paused the video And I hope you went through and took a shot at answering this before we're about to reveal how we come up with this. This is a very common test question, so it is important that you know how to do these. So the accounting profit's $45,000. How did we get that? Well, the business earns $55,000 in revenues and has $10,000 in explicit costs. 55 minus the 10 gives us $45,000 for the accounting profits. But once again, we don't know whether it was smart for this person to stay in business or not. What we need to look at is the implicit costs as well. So the economic profits takes the accounting profits as a starting point, or total revenue minus total explicit costs of the $45,000, and then it subtracts the implicit costs. So here, what are our implicit costs? Well, one is the $50,000 per year job that was given up, right? That's definitely a cost you should consider when you'd ask the question, is it smart for me to stay in business? Or in this case, as an analyst, you'd say, is it smart for this person to stay in business? The $50,000, and then also $8,000. And the $8,000 that we see here is in lost interest income. The person made an initial investment of $100,000. The interest rate is 8%, so in the first year, $8,000 of interest income was given up. So that $8,000 should be a factor there. Now, I think a natural question to ask is, why don't we include the $100,000 in the cost for the business for the first year? There's a couple reasons for this. One, we make the assumption the money's not gone. Like if the business closed, the person would get this amount of money back. For some businesses, that's incredibly appropriate. If you decided to day trade, for example, that's appropriate. I, former life, played a lot of online poker. Well, if you want to become an online poker professional, you need what's called a poker bankroll. You want to have enough money that you can withstand the up and down swings that you will see, even if you're a winning player. Right? That money's not gone. If you decided to quit being a poker player, the money comes back. So that's one reason, is based on that assumption. That assumption isn't always true. The second assumption is, largely for this class, it's just a lot simpler. We could say the initial investment of $100,000 would be gone, or at least it would be diminished. If it is, though, how do you allocate it across year 1 of the business, year 2 of the business, year 3, year 4, year 5? Accountants do know how to do this. There's tax laws that would indicate how you do this. That's a little bit more than what we need to do in a Principles of Economics class. So part of it is just how we assume this business operates. The money's not gone. Part of it is just to make our lives a little bit easier. So we do not assume the $100,000. We do assume the $50,000 lost wages are a cost, and the interest income that's lost is a cost. So what do we end up for economic profits? Negative $13,000. So what does this negative $13,000 tell us? Well, this was 1 year of the business, right? It doesn't necessarily tell us the business should shut down. A lot of evidence is out there saying that the first year somebody opens a business, it's much more difficult to turn a profit than year 2, for example. So there could be short-term conditions, and the business will become more profitable over time. What it does tell us, though, is this individual is $13,000 worse off financially after 1 year of running this business than she would have been staying in the original position. Does this mean the business should necessarily shut down and go back to her old job if she can? No, right? Some people, to leave a job they dislike and to start their own business, it would be worth a loss of $13,000. Maybe she should. We really can't answer that question. What we can look at is the profitability. And this is what she should want to compare it on, though. Like, right? How successful is the business? It would determine how well off financially am I. That's a key component. You want to know that, okay, I'm $13,000 worse off this year than I would have been otherwise. That gives you a lot more information than just, oh, we made $45,000 last year. So this economic profit helps tell us, is it wise to stay in business or not? Second in-class exercise, or on the, if you're seeing this online, obviously, you're kind of going through the online exercise, I guess would be the way to phrase this. Second example, similar to the first in some ways. We have somebody who's considering giving up a job, right? Makes sense, right? If you own a business, you're giving up some income, likely, that you could be earning otherwise. So we'll assume this time it's a local teacher. It's making $30,000 a year in cash, $15,000 per year in benefits. This person wants to become an author. Figures $10,000 in startup money will be spent, money that earns 10% per year in the stock market. The assumption is $66,000 in revenue in the year and $20,000 in explicit costs. So once again, what I'd like you to do is pause this in about 10 seconds and try to determine what are the accounting and economic profits for this business. Okay. So again, I hope you paused it and took a shot at this first before we go through this together. 66,000 in revenue minus 20,000 in explicit costs. The accounting profits is just the 66,000 minus the 20,000, $46,000. As far as the economic profits, we start with that 46,000, and then we need to subtract the lost income, which will be 30,000. Here, the benefits play a role as well. And we'll just count this at the same ratio of $1, each dollar in benefits we'll assume is like cash. So that means 45,000 in lost wages and benefits should be considered, as well as $1,000 in lost interest income, $10,000 in startup money, earning 10% per year. That's $1,000 in interest income that this person won't earn. So the economic profits for this person becoming an author, it's zero. And this economic profit of zero is a very important number, a very important concept. An economic profit of zero does not mean this person is broke or this business is broke and they're going to go out of business and go hungry, right? What this economic profit of zero tells us is this business is earning just enough to cover all the opportunity costs, including lost wages and lost interest income. So the business isn't making the owner fabulously wealthy, but it's not making them any poorer than they were before. And the term we have for this is actually normal profits. A firm that earns zero profits, once factoring in the opportunity costs, like lost wages, that's called normal profits. The thing to note is zero economic profits, not zero accounting profits. So these people aren't broke. They're just making enough where running the business is good enough to stay in, but it's not making so much money that others want to jump into the business. In ways, we're going to see that this is an equilibrium condition when you have markets, this idea of zero economic profits. There's just enough profit. There's no benefit from anybody else jumping into the market. And at the same time, it's just enough profit that those who are in the business, in this industry now, running the businesses, don't want to leave. Right? If the profits were negative, you'd think businesses would want to leave. If profits were positive, some might want to come in. So this zero economic profits, it's a very important condition that is going to keep coming up. Total revenue, we've hinted at what total revenue is before. Here we more formally define it as price times the quantity. We do assume the same price charged for all customers. Once we get to monopoly section, we relax this a little bit and look at what happens under what is called price discrimination. Well, the average revenue, if total revenue is price times quantity, average revenue would be price times quantity divided by quantity. So the average revenue is just the price. Marginal revenue is the additional revenue that results from the sale of one extra unit. Okay. So again, we have an exercise. I'd like you to pause this in a moment and try to figure out both the total revenue and the marginal revenue for this firm, selling anywhere from 0 to 8 units of a product. Go ahead and pause it now. Okay. Hopefully you've attempted this particular problem now. So total revenue of price times quantity. So we see 1 times 12 for a total revenue of 12 for 1 unit sold. 2 times 11 for 22, 3 times 10 for 30 for the 3 units sold, increasing to a high of $42 in total revenue. And actually, as you get to 8 units, the price keeps dropping, so the total revenue, in fact, drops. Now, the marginal revenue, marginal meaning additional. You sell 1 more unit, what's the extra revenue you bring in? It's the change in total revenue as you sell 1 more unit. So as you go from 1 unit to 2 units, you go from 12 to 22 in total revenue. That's a $10 increase. As you go from 2 units to 3 units, total revenue goes up from 22 to 30. Marginal revenue goes up by 8, right? 30 minus 22 is 8. You go from 5 to 6, you go from 40 to 42, you see $2 in marginal revenue. And the last output on this chart, 8 units sold, $5. The marginal revenue is actually negative. Why? Well, the total revenue fell from 42 to 40. Question I'd like you to think about for a moment, and you can pause the video to think about this for a moment, is what's the right output for this firm to sell? So you could pause it for a moment to think about this if you'd like. So as far as what the right output for this firm to sell, the answer, right now we don't know, because costs aren't factored into the equation yet. Right now we're only looking at revenues. We know what maximizes total revenue, which is selling 6 or 7 units, but we don't have anything for costs. So right now we can't tell you what the right number of outputs to sell, right number of output for this firm to sell is. Maybe it's 0, maybe it's some number between 1 and 6. We could almost certainly say it's not 7 or 8. Because the 7th unit, you get no extra revenue. The 8th unit, you lose revenue. So we would know that it's likely either 0, 1, 2, 3, 4, or 5, or 6. And that will depend on the cost structure.